The middle class investors all make the exact same predictable mistakes time and time again. And in this video really proves yet again that the wealth gap is a knowledge gap. Now, I can be hard on this video because I was a victim of all these mistakes I mentioned in the video. So I know all too well from my own life and from what I've seen in other business owners' life, the exact mistakes getting made. The funny thing about the middle class investor, it is not a net worth, it is not a figure, it is not an income. It doesn't matter if someone's got $1 million, $10,000. It's the investment philosophy behind it. As I proved in my last video, you can give someone over $1 million and it doesn't mean that they're a good investor or they know what to do with the money or it's easy or it's not. So let's go through it. The retail hive mind investor. The biggest difference between the family office investor and the middle class investor is the middle class are an income statement investor, whereas the family office is a balance sheet investor. See, the middle class says, how much does this investment need to generate for me to replace my income? If I just made 5k a month, if I just made 10k a month, everything would be solved. And that is not true. First of all, because if someone even makes 300k a year, 500k a year, and they spend that same amount of money, their net worth does not grow a year if they don't invest anything. But yet, more importantly, they chase high yields. The number one mistake the middle class investor makes. They're obsessed with high yield. But what they don't understand is there's a law of financial physics. The law states if there's a high yield, there is a risk somewhere that you have not priced in. High yield is not income. It's often return of capital disguised as return on capital. It's the law of capitalism giving back the investor their money. So this can often end up in them buying a second low-wage job with 100% liability. And the family office investor, they understand that income is the slowest path to wealth. Their investment is how much does the balance sheet compound. They're not chasing the yield. Look at an example, a historic example, Berkshire Hathaway. Berkshire Hathaway never paid a dividend, but it compounded and it grew on the balance sheet. The most tax efficient way to grow wealth is the balance sheet growing. And it's a long-term horizon. The middle class investor has a short-term horizon and just wants the asset to pay them now and pay them today. But there is risk that they have not factored in. It doesn't matter what the investment is, it's all the same. If it's real estate, private credit, high dividend, it's a business, it's a franchise. They all have a high yield that looks like it doesn't have risk. But that's because the middle class investor doesn't know how to price risk. They think all risk is the same. Whereas the family office investor understands that not all investments have to carry the exact same risk. But you see, the middle class investor, they confuse their control over the investment and their effort with the outcome, which is a lie. Because you control the effort doesn't mean you control the outcome. Remember 6 years ago there was COVID. What happened to all businesses? They got shut down overnight. Their effort didn't dictate that. They cannot control interest rates. They cannot control the Strait of Hormuz being closed and oil prices spiking and inflation going up. They can't control these factors. The family office investor understands their effort doesn't dictate it. The business model is more important than the actual entrepreneur. The biggest one here is, where does the middle class investor get their information from? They get their information from things like Shark Tank, TikTok, podcasts, and news headlines. But it's always high dopamine content. The middle class investor is going to click on the video that says how to make 10k a month fast and easy with no risk. Yeah, that's the stuff they look at. They're looking at content that has zero barrier to entry. They're obsessed with top line revenue and net profit. Hyper-saturated, zero moat commodity schemes. So they look at Shark Tank. They watch a few episodes of something like Shark Tank or Dragon's Den or a business program, and they hear things like, oh, revenue is vanity and net profit is sanity. But that's only one piece of the puzzle. See, the family office investor, they look at low dopamine content. They're watching Bloomberg, they're watching the 10K filings. They're looking at private equity white papers. They're looking at analytical, boring content where the true alpha actually lies. It's high friction. There's a barrier to entry because you need to understand the basics of financial literacy, return on invested capital, pricing power. This is the barrier to entry, and that's exactly why there's alpha in it. There's no alpha in a video on YouTube with 1 million views, with a clickbait title, with a shocked face pointing to 10K a month. But the middle class investors all click on the same video, the same content, and think they have this Dunning-Kruger effect where they understand business because they watched an episode of Shark Tank. And they start up the businesses which have no barrier to entry. So this is things like your online businesses, your e-com businesses, dropshipping, Amazon selling, SaaS businesses, all the businesses that everyone is doing at the same time. There's no moat, there's no pricing power, and it's a race to the bottom. Because they understand net profit, they think they understand business, but it's not the case at all. So here's a perfect example of where a business can have a 50% net profit with barely any return on invested capital. So imagine you buy a hotel for $10 million. It makes $600K a year. It's so busy. And it takes home net profit $300,000. And to the normal untrained eye, they would say, that's a good investment. That's your profits, your net profit is 50%. But the actual payback period is 33 years before you get your money back. So to the middle class investor who's been trained on revenue and net profit, they look and say, look, 50% net profit, that's amazing. They fall into an even deeper trap where they would scale this business. They would say, let's open up another hotel. And because it has such a low ROIC, they need to take on debt. So really, the return on invested capital is less than what you would get on a treasury bill. But this person is blind to that because they see the revenue, they see it's maxed out 70% time a year. So they say, okay, let's expand. And they will be able to get debt easily because they'll have a high EBITDA. So they can take out loans and scale the business because they view the scale as a vanity metric disguised really as capital efficiency. So this is where the net profit confuses so many middle class investors because they think that's all that matters. Not to mention, the money supply is expanding at 6.8%, which is destroying their wealth in real terms. Slowly but surely, over a 10 to 20 year period, they're destroying wealth, they're destroying capital. The family office investor look at return on invested capital. So they understand that I'll invest in companies with massive pricing power, huge global monopolies that have got a track record of doing it for 10 plus years. 20%, 30% return on invested capital, rather than just holding a real estate asset yielding less than a T-bill. And again, it goes back to the middle class investor think because they have control, they hold the keys, they think that dictates the outcome. It doesn't dictate the outcome. There's a lot of it that's out with their control. The middle class investor, they always borrow money from desperation. So what they do is they hate their job so much, they say, I'm going to start a business. I'm going to make a big investment. They look for a silver bullet. And I hate to break it to you, if you're a middle class investor who wants to take a loan out to start a business, an unproven, untested business, commodity business, if you do not have the guts, the discipline, and the financial durability to slowly grind and save that money, the 100K for the franchise or the whatever it is, the BS business, you do not have what it takes to operate, grow, and run the business. Because guess what money is the easiest money to spend? someone else's money. It will be like sand through your hand. Just, oh, we need to buy this logo, this graphic designer. We need to buy an office. We need to do this. They do all these vanity metrics spending because they think action is progress. And they're fully liable. They've taken on a massive liable business. They've taken on debt. So they don't even understand the risk because they don't understand how to price risk. They think everything's risky. So everything's equally as risky, but it's not. It's not. The family office investor only borrows from a position of strength. So they'll borrow against their assets after the assets have already compounded and grown. They have a margin of safety and they're borrowing a small portion of a large capital base. This is from strength, not weakness. But the middle class investor make wild decisions out of complete desperation. They also will never listen to advice. They never listen to new input. In fact, they'll make decisions alone on a Tuesday night at 11 o'clock to start a business or to do something. Massive changes in their life, and they will block out any advice from anyone else because they just believe they have the Dunning-Kruger effect. They think they know all the answers. They think it's going to work out, but there's so much they don't know. Only people that will listen is people that have made enough mistakes to actually listen. If you don't believe me, try and tell like a teenage boy that he's about to make a bad decision. Good luck, because he's not going to listen. Yeah? Anyone that's ever dealt with children, teenagers, or anyone in their early 20s, they will flat out refuse any wisdom. So until they've made a few mistakes, then they'll start to listen. Capital efficiency, I've touched on this. The middle class investor is taking the slowest path through the highest tax brackets. Income, dividends, rental cash flows, short-term flips. They pay tax at every obstacle. The buy, borrow, die framework. The family office investor does not sell the asset, keep the asset compounded on the balance sheet. There's another type of middle class investor. The first middle class investor we talked about was guys that believe they can outperform the market. They don't know that that's what they're trying to do when they open up in a business, open up a franchise, open up something else. They are actually believing that they can outperform the market, because if you open a business, it doesn't outperform the market, that business had absolutely no purpose. It was a waste of capital, a waste of time, and it might as well never been opened. The other side of it is a middle class investor who hide behind intellectual sophistication and complex structures. These are usually the higher earning middle class professionals. So they'll look at case studies given by Wall Street of only 4% of companies can actually outperform the market. So what they say is, okay, well in that case, I will buy every single stock in the entire market. I'll use an all-world fund or an S&P 500. Okay, fine, that's better than the alternative. However, looking down on people and looking like you're morally superior because someone decides to learn corporate finance, they think that because 4% of companies create all the wealth, it's like a needle in a haystack. They truly believe that investing in a stock, a single stock, is the same as spinning a roulette wheel. They believe it's the exact same as a lottery ticket. But in actual fact, the Besson Binder study doesn't prove their point, it proves my point. The 4% of all companies that create all wealth are not hidden like a needle in a haystack. They are like the top 10 companies in the S&P 500. They're glaringly, blindingly obvious. They're blatantly obvious. Sloth disguised as sophistication is still sloth. They use indexing as theological shield to remain illiterate about corporate finance. But that's fine. Look, they'll forever be a passenger to the people that actually do learn corporate finance. But let's look at their actual understanding of risk. The view of risk is completely backwards across professionals, financial advisors, accountants, and these people that I'm talking about. Look at this example. We walk into a financial advisor's office and we say, my stock portfolio is Google, Microsoft, Meta, Apple, Broadcom, Nvidia, and Amazon. They own the digital operating system, cloud infrastructure, AI compute layer, global e-commerce, and the rails of human civilization. They have a track record of 20 to 30% return on invested capital within their business, the financial advisor says this is extremely risky. This is a gamble. They confuse daily liquidity with financial hazard. Now, if I said to the financial advisor, I own Alphabet, Microsoft, Meta, Apple, Broadcom, Nvidia, and Amazon. Imagine they were all private companies. Does the financial advisor say they're risky? Well, he doesn't know they're risky or not because he needs to see the accounts. Well, how do you know it's risky? So the financial advisor, the mortgage broker, whoever it is, the professional says, okay, well, if they're all private companies and that's your source of income, we need to look at the financials. We need to look at the revenue, the net profit, we need to look at, the basics. Suddenly, it's no longer risky. Isn't that strange? So it's actually because they're public, they're risky, but it's the same asset. Here's another one. What if I was a W-2 employee salary at Google, making $350K a year? And I went to the financial advisor, the mortgage broker, and said, look, we need to borrow some money. What does the financial advisor say? They say, okay, just show me your payslip. But isn't this a concentrated bet on Google? My entire income is from Google because I work at Google. Isn't this a concentrated investment with high risk? No, suddenly it's not. Why is it not? Why not? Well, because you're employed by the company and it's a large global company. Hold on, we're still talking about the same asset. We're talking about the same asset, and the risk is now changed. The risk is completely changed. This is evidence and proof that the volatility of a stock ticker moving up and down is not actual real risk. Risk is permanent loss of purchasing power. It's a fallacy. It's volatility fallacy. So the financial advisor, modern portfolio theory is wrong. Their incentive is to protect their own job. So to protect their own job, they say just buy the whole market so I don't get in trouble. What about this? A local plumber. The local plumber has $300K a year, they make net profit, and they want to borrow money from the financial advisor. Can you get me a mortgage? Can you get me a loan? What do they say? They say, well, we just need to see two years of tax returns. Can you show me your tax filings for the last 2 years? And you can get the mortgage, you can get the borrowing. But wait a minute, that's a single concentrated business. They don't view it as risky. They just want to see the tax filings. But yeah, it's got a single point of failure, 100% geographic concentration, there's no moat, equipment decays, total dependency on one or two key workers, and the sales take 6 to 12 months. But the advisor thinks it's a stable, low-risk entrepreneurship. They stamp the approval. It's considered safe because there's no live ticker screen. So the absence of a daily quote creates the illusion of stability, despite being infinitely fragile. And the middle-class investors, this is how they view risk, the exact same way as professionals, because they don't have any first principle thinking. In fact, many adults no longer have first principle thinking, but we're all born with it. We're all born with first principle thinking. Children all have first principle thinking. They ask so many questions to their parents, why this, why that, why this, why that, and eventually the parents get so fed up answering questions, they get fed up and they lose their patience. And children are then trained to stop asking so many questions. So adults stop doing it. But it's the highest ROI activity. Thinking is the highest ROI activity on earth. What is actually thinking? Thinking is simply just asking yourself questions. Deep, profound questions like, why am I even investing in this? Why do I believe that? But these are uncomfortable. No one wants to actually allocate an hour of their week to sit down and think about what they're even doing. Is it even producing any results? Is it productive? And they don't want to learn corporate finance, income statement, cash flow statement, balance sheet, because it's low dopamine and it's high friction. But especially with a public company, an SEC filing, SEC regulated public companies have nowhere to hide. So if you understand even just the basics of cash flow statement, income and balance sheet, and calculating the ROIC, there's nowhere a public company can hide. Now, here's the problem with the middle class investor. They don't want to spend any time thinking. They want to lease conviction from someone else. So what happens is they go online, they find someone to tell them what stocks to buy. So they have absolutely no conviction in the stock, none whatsoever. And when the stock does drop, eventually, inevitably, they demand an explanation. They demand the market explains to them why it dropped in 15%. So they go into forums, they go into Reddit, they go into the people that told them about the stock, and they demand explanation. Tell me why this stock has dipped. They have no conviction whatsoever. And it's a lease. Whenever someone tells you what stock to buy, it is a lease until it crashes. So some influencer, someone on TV told you to buy a stock. They have no thesis, they have no understanding, they have no conviction, they don't understand the business. There is no psychological armor. Whereas the family office investor understand the market does not owe them anything. They understand it's more complicated, and as long as they understand the core understanding business, that's all that matters. The middle class investor says, I don't have time to learn anything about corporate finance. Yeah, I'm not going to read a 10K. I don't have time. Well, they have plenty of 50 hours a week on low dopamine consumption, TikTok, video games, Netflix. Yeah, so they have plenty of time for entertainment and other things, but they don't have time to do the highest ROI activity. Thinking is the highest ROI activity. Then the ones that do invest, they attach themselves, their entire identity to the investment. So if someone is a real estate investor, that is their identity. So it's no longer a case of being a capital allocator who's emotionless and ruthless. If they have no, they attach to it. So if the investment fails, their ego doesn't want them to admit it. So they wait until it's too late. This is why people sit and fail in businesses for 10 plus years, because their actual identity is attached to the business. It's attached to it. Whereas the family office investor is completely detached. Completely detached. So if the investment is not doing its job, liquidate. If it was a bad investment, and then use that to learn to the next one. The middle class investor, that genuinely hurts them. And it can be as well in other investments, not just real estate. You see this a lot in cryptocurrencies, where retail investors become actually emotionally attached to the identity of the investment. So selling it feels like an ego death. So they'll hold losers to zero. It really hurts them and causes a lot of emotional pain. And again, the middle class investor, they view frantic activity as progress. Yeah, so frantic activity, 1,000 hours of frantic middle class hustle can result in a 50k net loss over the years, whereas 100 hours of institutional deep thinking can actually generate more net worth wealth over their entire lifetime. Because sitting quietly in a chair for 3 months, reading filings and making a decision on an investment can actually have a higher ROI than just taking blind action. This is why patience and thinking is so powerful. Rather than just constant dopamine, constant action, the feeling of making progress by just watching high dopamine content. It's so bad for the middle class investors. All do this. Whereas, as I will keep saying it, higher ROI. They do not value their own time. So when they take on physical infrastructure, physical businesses, they price their own physical time at zero. So they think the scaling equals progress. So they'll buy more properties, buy more infrastructure, buy more businesses, more franchises, grow, more. And all they do is substitute their own biological human labour to capture the yield less than a treasury bill. But if they actually just stopped and sat down and said, is this actually the best use of my time? They would have a higher ROI. So they'll cling to stagnant assets because it cash flows, because again, they chase income. Whereas the family office investor, detached, they value their time, they value it, so they invest in monopolies who have the pricing power, who have the moats, who can grow without their physical labour involvement. So there you have it. Majority of the differences between middle class investors and the family office investor. It's mindset. It's not just about the net worth. Psychology and education. Low dopamine content is where it actually lies. Yeah. And something else I want to mention on the Shark Tank as well, because a lot of middle class investors watch this, they don't realise is the Shark Tank is actually, they're actually subprime lenders. They're subprime lenders because the most expensive cost cost is equity. And this is another illusion that middle class investors have. They give up equity, even on a business. The only people that should be giving up equity is if the company is going to become a monopoly. It's a future monopoly. It's a future giant. What they don't understand is if the Shark Tank lends them, 20% loan, 20% equity, and they exit the business in 10 years' time, that cost of that loan was like 1,000%. It's far more expensive than debt. And you might say, well, the sharks actually create value. They don't invest in a dead asset. They only invest in something that's got a proof of concept. So they're technically, while they look like sophisticated venture capitalists, they're really just milking the presentation. And do you know what happens after the episode? The sales from the episode mellow out. The ones that end up winning are the Shark Tanks. That's why it's called Shark Tank. And if the business owners went onto that program with corporate finance knowledge, they would understand it would be cheaper to take out debt. It's far cheaper to take a loan at like even 8%, 10% is cheaper than 1,000% loan of a business. That was something that wasn't on the presentation, but I just wanted to mention it. But there you have it. Become a balance sheet investor. Liquidate broken thesis in 10 minutes. Ego is dead capital. Ego is the biggest killer as well. Seek advice from other people, professionals, counsel, listen to feedback. Don't consume high dopamine social content. If the content is actually clickbaity and high dopamine, it usually is directed to a middle class investor. Strict high moat, zero marginal cost, strict but only borrow from strength, preserve tax-free compounding, build an autonomous balance sheet, do not buy a second low-wage job. I hope you enjoyed. Link in the description if you haven't already submitted to my email list.